Welcome back, still watching the newsroom. Let's get an FI voice going in. Manishi Raychaudhuri, who's joining us from London right now, is the BNP Paribas Asia Pac head. Manishi, thank you very much for your time. How are you analyzing the market right now? Economy is still sluggish, earnings recovery patchy, and the market's at all-time high. In fact, the broader market has also started moving. How are you analyzing the equation?
One of the reasons is that the Indian market and the Indian economy are two different animals. So if one looks at the structure of the Indian market, particularly the large cap frontline stocks which make up the frontline indices like the Sensex or MSCI India or let's say Nifty 50, quite a few of these are basically market share gainers or which are beneficiaries of additional penetration in the market. Let's say the insurance sector, or let's say the private banking sector, or the large cap stocks, which are gaining market share as a consequence of the move towards formalization that we are seeing. So I think this is partly what explains the disconnect between the economy and the way the market is performing. The frontline indices are, disproportionately weighted in front of these large cap stocks in various different sectors which are in the process of gaining market shares from their smaller cap peers.
So do you say that in the medium term or for some time the market can remain polarized the way it has been? Can it continue to be led by just a handful of stocks? How do you see things pan out?
To some extent, we have already seen that, especially if one notices the kind of stocks that the foreign investors have invested in over past few months or even, over the last couple of years. Their investments have largely been concentrated in the frontline large cap organized sector companies. I think going forward, at least in the near term, there may not be a significant departure from that trend. Even when one tries to identify stocks which are secular free cash flow generators or compounders which are secularly generating higher return on equity than cost of equity, one actually comes up with most of these names, the large cap frontline stocks in most sectors. So, I think, in the present environment when most investors are looking on some degree of capital gains along with a significant degree of safety, there may not be a significant departure from this trend that we are seeing.
Let's talk about the auto space. Stocks like Maruti, M&M, a clutch of them have rebounded very sharply from the lows, and the numbers also show some amount of feeble recovery on a month-on-month basis. How are you analyzing that particular sector? Do you think a firm bottom is in place, or the weakness can come back?
I think it's too early to call an end to the pain in the auto sector. There's been some degree of destocking, as far as the OEMs are concerned. There's some degree of pre-buying that we have seen, but at the same time, for consumer confidence to be rekindled and consumer interest in buying the new models to come up, we have to wait for the new emission norms to be implemented. So we don't really have any exposure to the Indian auto sector yet in our model portfolio, the Asian model portfolio. We're possibly watching this space keenly, but I think it's too early, too premature to take a plunge.
Manishi, there's also an issue which is being discussed in the market. Some stocks, the likes of DMart, for example, where the floating stock is low, but the structural strength of the business model remains. A very high quality business leaders are running the company, very well run, but the valuations are very high, sky high. But still fresh money continues to chase such names. This kind of phenomena which is playing out, how do you analyze what's happening in such names?
I wouldn't name any stock in particular, but the key to investing and the key to generating alpha is obviously to identify growth stocks which are, cash generative and excess return generating over the long term with an eye on valuations. So, I don't think any prudent investor should completely ignore valuations, but at the same time, we are living in a period where high quality comes with relatively expensive valuations. So, if we are able to identify stocks which appear relatively expensive but are showing steady growth and offer good corporate governance and, in particular, strong free cash flow generation and strong excess return generation, then I think, investors can still take a look at such a set of stocks. One would avoid egregiously expensive stocks, though.
In light of the slowdown fears this time triggered out of China because of Wuhan virus and the impact it can have in slowing down the rest of the world, in that backdrop, how do you analyze global sectors like metals, commodities in particular? Or do you see some more weakness set in? There was a rebound in metals when the trade deal happened between US and China, but because of China, the virus scare, again, that entire rally got fizzled out. How do you analyze metals?
You see, the metals and mining space are something that we are avoiding right now. And we think that in times like these, when China is slowing down, not just because of the recent coronavirus scare, but also even organically, it is prudent to avoid the kind of commodities where China accounts for about 50 to 60% of global consumption. So, a short answer in a nutshell would be, we are avoiding the metals and mining sector right now, and it is unlikely that we would be getting interested anytime soon.
All right, Manishi, before I let you go, I need to understand your thoughts on the mid-cap end of the market. There has many names out there have seen some recovery, and the market men are excited once again that this year it could be mid-cap end of the market which could give you best returns because valuations are attractive. What are your thoughts on the broader market?
We are not really making any broad brush call on the mid-caps, even any of the sectors. We apply the same yardstick to selecting mid-cap stocks, as we do for large-cap frontline stocks. If we find there are consistent growth opportunities in any mid-cap, the companies which are gaining market share within their, respective space, then, and at the same time, within those companies, the ones which are secular excess return generators, and I keep coming back to this point because we're very keen on identifying the compounders, as we call them, where the return on equity is consistently higher than cost of equity, then those are the kind of stocks that we get interested in. There are some of these stocks that are available in the consumer discretionary space. There are some which are available in the financial space as well. So I think those are the two sectors that come to my mind. But, the bottom line is that in investing in small and mid caps, one has to be selective, one has to be discerning in, in the kind of stocks one invests in.
All right, Manishi, we'll let you go on that one. Thanks so much for talking to us today all the way from London. Always wonderful to have you on the show. With that, we're completely running out of time on this edition of the Newsroom. Thanks very much for watching. Goodbye.